Alright guys, good day once again. You're welcome back to my channel. This is a video on market structure. I'm going to have a discussion with you on market structure, how the market is structured. Alright, so this is going to be quite long, so I'm going to break it down into part 1, part 2 and part 3. Yes, I'll do it part 1, part 2 and part 3. So when you watch, this is the part 1. So when you watch this part 1, look out for the part 2 on the channel, and then look out for the part 3. Okay, so the part 1, part 2, part 3 will cover the entire market structure. All right, so this is my personal note. On Telegram. You can search for Ikalen underscore FX zone, Forex zone. Okay, when you search for it, I'll make sure I leave the link in the description. You can come here and look at the various notes on our lessons on the Forex mastery class. All right, so let's delve into the market structure. Also, I want you to spend a second, just like the video. Yes, if you think it's useful to you, you can like it now, or you can like it at the end. Leave all your questions in the comment section. I will respond to it as swift as possible. All right, so let's move into the market structure. Okay, the title is the market structure. Now, what is market structure? Now, the market structure is how the market moves, or the behavior of the market when you open your charts. All right, so as a price action trader, the most important skill you should have is your ability to read the market structure. When you open your chart, you should be able to determine whether the bulls are in control of the market, or the bears are in control of the market, or the market is also in some form of equilibrium, meaning that there is no precise direction. The market may be ranging. All right, good. So that is what we are about to do now. Follow me closely as I take you through the market structure. Okay, so as a trader, you're not going to treat all the markets the same. Okay, depending on what the market communicates to you, or depending on what you see in the market, that should actually tell you your decisions you have to take, whether to buy, sell, or to stay away from the market when you think you are not see a clear direction of the market. All right, so you should be able to master this skill. Okay, when you open your chart, you should be able to answer the following question: who is in control of the market? Is it the buyers or the sellers? What is the right time and the place to enter to or exit the market? Okay, the right time to enter the market, the right time to exit. All right, and the right time to stay away, or if you have to stay away from the market. So these are questions you should be able to ask yourself as a price action trader when you have knowledge or the skill of the market structure. All right, so let's delve into it right away. There are 3 types of markets. You should note that there are 3 types of markets. We have the trending markets, we also have the ranging market, and then the last one is the choppy market. So we are going to look at each of these 3 different types of markets. All right, so this episode, part 1, is going to take care of the trending market, then the part 2 is going to take care of the ranging market, and then part 3 will be on the choppy market. Okay, so let's delve into the trending market. Now, trending markets are simply characterized by a repeated pattern of higher highs and higher lows in an uptrend market, and lower highs and lower low in a downtrend market. What does that mean? Now let's look at this example here. Let's look at this chart. Okay, so we said in an uptrend market, it is characterized by, or it has the characteristics of forming higher highs and higher lows, higher highs, higher lows, higher highs. So when you see the market in this nature, forming swing highs and then swing lows, swing highs, swing lows, swing highs, it tells you that the market is clearly in an uptrend. It tells you that the market is clearly in an uptrend. So when you open your chart and you see the market in this direction, it is a clear indication that market is in an uptrend. This picture also depicts the same thing. Market forming higher highs, higher lows, higher highs, higher lows, higher highs, and then higher lows. All right, then we look at a clear example on the chart. So let me enlarge this small so you would see. Now you see market price moved from the lower point, okay, the major support level. Price went up to form a higher high, then it retraced to form a higher low. It went up again to form a higher high. We have higher low, higher highs, okay, higher highs here. We have higher low, retraced a little to form a higher low, higher highs, higher low. So when you see the market in this clear direction, you can see that the market price was moving from the downside to the upside, telling you clearly that the market is in a what, an uptrend. So when you open your market, when you open your chart and the market is in an uptrend, forming this kind of characteristics, it tells you clearly that the market is in what, in an uptrend. Okay, it's in an uptrend. Now let's look at a downtrend. I told you that there are two types of trending markets. We have an uptrend market and we have a downtrend market. So in an uptrend market is a situation whereby you see price moving from the lowest level to the highest level. Okay, price moving up, meaning that the bulls are in control of the market. In an uptrend market, the bulls are what, in control of the market. Then we go to the downtrend market. And the downtrend market is just the opposite of what, the uptrend market. So in a downtrend market, you see price forming what, lower lows and lower highs, lower lows and lower highs, lower lows and lower highs. Okay, now the reason why we have this lower lows and lower highs is that you see price will be moving from this high point and then it will drop, forming a lower low. Then price will be traced a little. Okay, you know the market does not move in a linear form. It doesn't come straight. It moves with an impulsive move and then a correction move or a retracement. Okay, so when it moves down, it forms a lower low. When it retraces up, it forms a lower high. The reason why this is a lower high is that this is this high here, or this point here, is high. It's higher than this word low. Okay, it's higher than this low, but it's also lower than this high. So this is a lower high, lower low, then a new lower low will be formed. This low is lower than the previous low. That is why it has the name lower low. Then it forms a new retracement. This is also a higher, but it is lower than the previous what, high, lower high. So we have lower lows and lower highs. When market starts forming this what pattern, it tells you that the market is in a downtrend. The same thing here. Okay, the same thing here, forming lower lows and lower highs, tells you clearly that the market is in an uptrend. So this is a clear example of a downtrend market. You realize that price moved from the highest point to the lowest point, and it was forming a series of what, lower lows and lower highs, lower lows, lower highs, lower lows, and what, lower highs, in that order. Okay, well, when we see this kind of pattern, it tells you clearly that the market is in a downtrend. Now there is this little note I made here. It says trending markets are easy to identify. Don't try to complicate your analysis. Use your brain and see what the market is doing. If it is doing series of higher highs and higher lows, it is simply an uptrend market, like I told you. Conversely, if it is making series of lower highs and lower lows, it is obviously a downtrend market. Now, according to statistics, trends are estimated to occur 30% of the time. Okay, the market trends 30% of the time. So while they are in motion, you've got to know how to take advantage of them. To determine whether a market is trending or not, you have to use bigger time frames, such as the 4 hours, the daily or the weekly time frames. So always make sure, if you want to see the market structure, make sure you analyze it from the 4 hours, the daily, and then the weekly, or you start from the weekly, then it comes to the daily, and then at least 4 hours, to be able to understand and see the overall trend of the market. Now never try to use smaller time frames to determine the market structure. Don't use smaller time frames to determine the overall structure of the market. All right, so now we know how to identify downtrends and uptrends, and how to differentiate between an impulsive move and a retracement move. This is very important for you as a price action trader to know. But the most important question is how to identify the beginning of the impulsive move to enter the market in the right time with professional traders, and avoid being trapped by the retracement move. Okay, so let's go back and see how to trade. Okay, I'm going to use this to demonstrate. We're going back to see how to trade if the market is in an uptrend. That is the right time to enter the market and the right time to exit. Okay, and then if the market is in a downtrend, the right time to enter and the right time to exit. So this brings us to another important topics which we'll be using in our entries, that is support and resistance levels. Now, what is support and resistance levels? Now, support and resistance are proven areas. They are proven areas where buyers and sellers find some form of equilibrium. They are major turning points in the market. Support and resistance levels are formed when price reverses and change direction, and price will often respect these support and resistance levels. In other words, they tend to contain price movement until, of course, price breaks through them. Okay, so let's look for example. Okay, so first of all, this is an uptrend market because price is making a series of higher highs and higher lows, higher highs here, higher lows, higher highs, in that order. Okay, so this is a clear uptrend market. So price makes an impulsive move up, forming a swing high. Then there will be a retracement, forming a swing low. So what you do is, where price got to and then reversed, you put a line there which is called a resistance. Now, the reason why it is called a resistance is that it prevented price from going higher. Okay, so it prevented price from going up. So you put a line, you draw a line there that serves as your resistance line, and then where the price retraced up to, you put another line there to serve as a support. So you have your resistance and then you have your support. And whenever price retraces in an uptrend, whenever price retraces, it start to make another impulsive move up, okay, to break the resistance. So when the price makes an impulsive move up to break the resistance, this resistance will now tend to be a support because price is now above the resistance. So when price is coming down, it will come back to this line as a support. So this will be our new support. The previous resistance will now act as our new support. So when price breaks through the resistance and goes higher, you wait for price to retrace back to that line as a support, and this will be the right time for you to enter the market. So you enter the market here, and you wait for another impulsive move. You wait for another impulsive move to be able to take profit at a higher level. So you can take your first profit here. Okay, you can take your first profit here, and then you wait for price to go up again. Then it retraces back to the resistance, which is now serving as a new support, in that order. So that is how you trace it. You wait for the price to break the resistance and then retrace back to the support. You buy from the support and price makes another impulsive move up. So this is how to trade an uptrend market. Always wait for the retracement move and then you join the impulsive move up. So that's how to trade an uptrend market. Now let's look at how to trade a how to trade a downtrend market. So in a downtrend market, you realize price will make an impulsive move down. Let me enlarge this small. You realize that price will make an impulsive move down and then it will retrace. So where price got to and then retraced, you put a line there as a support, because this support or this line prevented price from going lower. It prevented price from going lower. So this will be our support. Then where price got to and then make another impulsive move down, you put another line there as your resistance. Okay, now when price tends to make an impulsive move downwards, you realize that it breaks through the support. Now whenever price breaks through a support, that support line now becomes what? A resistance. Because when price retraces back to that line, it will prevent it from what? Going up. So this now becomes what? A resistance. So what you do is you wait for an impulsive move to break the resistance, for price to retrace back to the what? The support, which will now act as a resistance. So you sell from this end, you sell from this end, okay, you sell from this end, and then you wait for another impulsive move down, then you join the sell. So you with this new support, you put a line there, you wait for price to break that line and retrace back to it, then you sell again. That is how to trade what? A downtrend market. And always when you sell from the resistance, what you do is to put your what? Your stop loss above the previous what? High. You put your stop loss above the previous high. So let's do that for an uptrend market. So in an uptrend market, if you buy from what? The support, and you are anticipating for the impulsive move up, when you buy from this end, you have to make sure you put your what? Stop loss below this what? Below this low. Okay, below this low, you put your stop loss below here. All right, if you think the number of pips is higher, you look for a reasonable amount of pips, and then you put your stop loss over there. Okay, so that is it for the support and resistance levels. You put your what? Your swing high, you put your resistance. Your swing low, you put your support. You wait for price to break it, come back to the support, you buy, goes up, in that order. Okay, so that is how to trade in an uptrend and then a downtrend market. Okay, so this is a typical example. This was an impulsive move down, this was a retracement. So you sell from this end, you wait for price to break through the support here, and then when it retraces back to the support as resistance here, you sell from that end. So that is how to trade a downtrend market. Now another way to catch the beginning of an impulsive move is by drawing trend lines. So we want to look at what a trend line is. Okay, this is another technical skill that you have to learn if you want to identify key linear support and resistance level. So we shall look at what these trend lines are. Now let me explain. You first, quite often, okay, when the market is on the move, making new swing highs and lows, price will tend to respect a linear level, which is identified at what? By a trend line. Bullish market will tend to create a linear support level, and bearish market will form linear resistance level. Now, what is the meaning of just what we just read? So that is what we want to look at. I'll explain them, break it down for you. Okay, so how to draw a trend line. Now, to draw a quality trend line, you will need to find at least two minimum swing points. You need to find at least two minimum swing points and simply connect them with each other. The levels must be clear. Don't try to force a trend line. Okay, don't use smaller time frames to draw trend lines. Use always the 4 hours and then the daily time frames to find obvious trend lines. So like we said before, always make sure you are making your analysis on a higher time frame. All right, so this for example, you realize that market was in what? An uptrend. Let me put this here. You realize that market was in an uptrend. It was moving from the downward to the upside. Good. Now when market is in an uptrend, you realize that it will be making series of higher highs, higher low, higher highs, higher low, higher highs, higher low, just like I have explained earlier. But another key thing is that when market is making this movement, higher highs and higher low, you will see that market will be respecting key linear support level. So when you draw a straight line to touch this lows, you touch these lows, okay, you realize the market was moving in a linear, or is respecting a linear level. Okay, it's respecting a linear level, which is another confluence, or another signal for you that whenever price gets to the trend line, it buys. Whenever price gets to the trend line, it buys. When it gets to the trend lines, it buys. So this is another key technical tool, that is drawing a trend line. All right, so let's look at that of a downtrend market. Okay, this is another uptrend market. So you realize price is respecting key support levels, and then when you draw to touch the swing highs, you see that market will be respecting a key resistance level. So in an uptrend, market will be making this series of moves, and then you get to have other factors of confluence. Okay, now this is another typical example. So this at this point, market was in a downtrend. It was respecting these trend lines. Always make sure when you are drawing your trend line, you have at least 2 points touching the line. Okay, when you have more points, that is very good, but at least you should have 2 points. Okay, so market was making higher lows and lower lows, higher lows and lower lows, in that order, until there was a breakout at this point. At this point, when market breaks the trend line, you realize that market would now start changing direction. Whenever there is a breakout, it means market is about to take a new direction. So you should take note of that. All right, so this is the end of the trending market. So now we have looked at trending markets and how to trade them. The trend line also guide you when to sell. Okay, so when you get to the trend line, you sell from the trend line. Okay, and then markets will be coming down. Whenever you get to a trend line, it will be in confluence with your resistance level. So you sell at that point, and then price will keep dropping. All right, so this is the first part of our market structure. We'll be looking at the second part in the second video, or in the next video. We shall look at the ranging market. Then we'll move on to the third video, which will be our choppy market, and then we'll be done with the entire market structure. If you have a question on what we have discussed so far, leave your comment in the comment section, and then I'll respond swiftly to it. Thank you so much for your time. Have a wonderful time.